It's determining if you're a good risk. It's kind of crazy to think that someone in my mother's generation may have had a rough time getting a mortgage on her own. When you put garbage in, you get garbage out. It can't play favorites, and I would never have allowed this client to get a mortgage. Welcome back to Mortgage Like a Mother. It's time to talk terminology. Even though the following mortgage terms are not a foreign language, they may as well be if you don't understand their meaning and how they impact your mortgage pre-approval. Remember our mantra, you don't know what you don't know. As humans, we're always learning new things, but there's a difference between learning about a topic and truly understanding it. This is crucial when we're talking about your pre-approval, because you can't be toying with the pre-approval process when you're entering into the biggest financial purchase of your life. You don't want anyone talking over your head or talking in circles around you, because that leaves a huge opportunity for them to take advantage of you. And trust me, they will. So before going any further in the pre-approval process, you'll need to understand 3 commonly used terms in the mortgage industry. Let's take a quick and kind of funny look. When a lender takes your mortgage application, it's run through a computer program known as the Automated Underwriting System. This system relies on data analysis and algorithms, and I know that sounds crazy, but it's not, to figure out if you're gonna get approved for a mortgage. Bottom line, it's determining if you're a good risk. Because a computer can't make decisions based on personal opinions or judgments, it's designed to comply with fair lending laws that prohibit discrimination. It also reduces the likelihood of human error, which can lead to unintentional favoritism. Let's have some fun with a few crazy examples. Imagine being a mortgage lender prior to having an automated underwriting system. Your local doctor approaches you for a new loan on his vacation home. His credit shows that he is consistently late on all his bills, including the first mortgage he already has with your bank. It's obvious he's not a good risk. If you didn't know this applicant and were given his file, you would, without a doubt, issue a denial. But you see him at church every Sunday, and he coaches your son's Little League. He's about to deliver your second child next month. How can you say no to this person? This is favoritism. When he defaults, he is not only costing the bank money, but the bank's other customers, including you. The automated underwriting system can't play favorites, and I would never have allowed this client to get a mortgage. It doesn't have the ability to involve emotions, social consequences, like your son getting benched, into the decision-making process. It's definitely an improvement from the good old days, unless, of course, you're the doctor. Protected classes in the context of mortgages refers to groups of individuals who are legally protected from discrimination when they apply for a mortgage loan. These include race, religion, national origin, disability, color, familial status, and sex. Before the Equal Credit Opportunity Act was passed in 1974, and yes, I was born before this, so it wasn't very long ago, my friends, women encountered widespread discrimination in accessing credit. If you weren't married, you probably were not getting a mortgage unless your rich daddy co-signed for you. How would you feel if you were a single female with a good job, great credit, and substantial nest egg, and yet you were told you couldn't get a mortgage because you might have children someday? Once again, automated underwriting systems were designed to assess loan applications based on objective criteria and not discriminating practices. It's kind of crazy to think that someone in my mother's generation may have had a rough time getting a mortgage on her own. And that was in our very recent history. It's insane.
Listen up, you might just learn something.
Automated underwriting systems are designed to process a huge amount of information really quickly. However, if the information entered into these systems is inaccurate, incomplete, or misleading, the decisions they generate will be flawed and unreliable. And nobody wants that. When you put garbage in, you get garbage out. Oscar the Grouch lived in a garbage can, and his favorite saying was, "Ding dong, you're wrong." Why should this crazy little creature and his favorite saying be so important to you? Well, in recent years, there has been a trend towards the actual borrower entering their own information into an online system at 11 p.m. at night while drinking a beer. In and of itself, this is fine, but make sure you are working with a lender that verifies what you input, understands the guidelines, and knows the right questions to ask. Your approval and closing depend on it. Oscar's second favorite saying was, "I love trash." If your mortgage pre-approval is based on trash, your entire experience is going to be landfill worthy. Remember, you want to be one of those people that has a phenomenal experience, and that, my friend, depends on you. The automated underwriting system is the #1 term you need to understand when getting an accurate and solid pre-approval. Number 2 is your debt-to-income ratio, which measures your total debt payments as a proportion to your gross income. Imagine that you have a box, voila, of 12 donuts representing your gross monthly income. Let's take a peek at how this looks with actual dollar amounts. If your gross monthly income is $6,000 a month and you have 12 donuts, each donut would represent $500 of your monthly income. Now, let's say that you're applying for a new mortgage loan that allows a 50% debt-to-income ratio, otherwise known as DTI. In this case, that means the donuts that have sprinkles on them are 50% of your income, so $3,000. If you already have $1,000 in payments, maybe student loans or cars, then you only get $2,000 for your new home. So what does a lender count as your current monthly debt? Maybe you have a car payment, student loans, credit cards, child support, alimony. There are things that your debt-to-income ratio for loan purposes don't take into account. Things like your utilities, your health insurance, your car insurance, gas for your car, food for your table, those horrible income taxes that we all pay, and maybe your 401k contribution. These are paid by the other 50% of your income, the things that don't have sprinkles. Now, if you have more debt, you'll have more donuts dedicated to your debt payments and be able to afford a lower house payment. But if you have less donuts set aside for current monthly debt, you can afford a higher house payment. As a buyer, it's so important to take into account your lifestyle and saving habits. There are trips and life events, hobbies, retirement to plan for. You don't want to be house poor. Know what you're comfortable with before you start looking for a home. Someone, and I'm not sure who, once said, "Know before you go." It's a very smart thing to remember before you get in that car and go looking at homes. The third term you need to know for the pre-approval process is something called loan to value, otherwise known as LTV. There are no props for this one, and I know you're very sad, but it's very short and sweet. Your loan to value tells you how much of your home's price you'll need to borrow. It helps show how much skin you have in the game and how much of your own funds you'll be using. For instance, if you have a down payment of 5%, your loan to value is 95%. If you have a down payment of 20%, your loan to value is 80%. You are financing 80% of the value of your new home. Some loans require 0 down, like VA if you're a veteran, or rural development loans. Certain conventional loans require 3% down, although 5 to 20 is way more common. FHA loans require a minimum of 3.5% down. We'll talk more about loan types and payments a little bit later. You are so much smarter regarding mortgage lingo than you were just a few minutes ago, and that will have a huge impact on your mortgage success. Plus, you got a laugh or two at some seriously ridiculous props. We hope it helps you to remember and understand the important stuff. When we're talking about being Oscared next time, you'll know exactly what we're referring to. So let's move on to the next video, where wine may or may not be involved in teaching you how to be successful when it comes to having the best pre-approval letter. Just like a good wine, this letter can make all the difference in the world and give you a leg up on the winning offer on that dream home of yours. Please don't forget to subscribe, like, and follow. Maybe throw in a little happy dance while you're at it. I'm here for any questions you have because we want to make sure you do this thing right. Until next time, my friend, have a good one.